Welcome, Arthur.
So, good morning, everybody, and thanks for joining this edition of our discussion and dialogue at the CFO board. The topic today is of interest to everybody, I'm sure, on financing in a post-COVID economy, facing the new dynamics. So, I'm going to now request Chair of our Executive Committee, Mr. Mahalingam, to start the proceedings. You all know about the speakers. So, Mr. Mahalingam, over to you, please.
Yeah, thanks, Pranjal, and let me also welcome everyone to this webinar on financing in a post-COVID economy. Of late, we have been organizing at the CFO board a few of these webinars, and I'm sure some of you must have attended them and found them to be very useful. This, of course, fits at the senior professionals in the finance activity. Today, of course, we are dealing with a very interesting topic that we thought would be of great relevance to us at this time. It is financing in the post-COVID world, and of course, we are thankful that Keki Mistry is giving the special address because he has just finished raising, if I'm right, about 1,000 crores in the market. And that should be of very major interest to all of us in terms of how he performs the environment. The way I look at it is this, that there is a demand side as well as a supply side to those. There is, of course, demand. Demand is of different categories. Of course, there is this question of running the organization. COVID kind of affected the environment, which is, of course, generating its own demand. The second thing is, as a result of this, there is any restructuring in the capital base and so on. That's another demand. And the third one is looking at the opportunity, looking at it as an opportunity and turning it around. In fact, we also have Saurabh Jain, who is also a CFO board member, contributing to this along with KPMG and other of his colleagues from NIIF. Again, we all know that infrastructure funding is very critical at this point in time. But then NIIF itself comes with its own innovative ways of structuring the whole financing of the infrastructure. Again, in this environment, how that is shaping up is going to be an extremely important one. So this is on the demand side that I talked about. On the supply side, of course, we know how things are. There is no problem as far as liquidity as we see that, as we see it now. But then, there are many other issues, whether it is in terms of bond market. There have been issues from an ILFS, demand housing, and Franklin Templeton, many of those kinds of things which are also affecting our own the environment, and therefore, what are the various avenues that are available in terms of generating funds at this point in time is the issue that we will be discussing. So, without much ado, I'll now pass it on to Keki for his special address, and thereafter we'll take Q&A with Keki for about 10 minutes, and then I will turn it over to Saurabh after that. So over to you, Keki.
Thank you, Maha. Thank you very much. I'm going to turn off my video if you don't mind, because I'm having some problem with the bandwidth. Okay, so good morning, all of you. It's a great pleasure to speak to you, and thank you very much to the CFO board for inviting me to share my views on financing strategies in the post-COVID-19 world. What I would like to do is cover the following topics over the next 10 to 15 minutes before moving on to question answers. I will try to cover 5 broad topics. First is a brief overview of the current economic scenario. Second is challenges faced by CFOs. Third is lessons from asset liability mismanagement. Fourth is funding strategies at HDFC, and that we can talk in more detail if there are questions. And 5 is, of course, conclusion. We are in the midst of one of the most unprecedented crises in history. The COVID-19 pandemic has had a devastating effect on the lives and livelihoods of millions of people all over the world. In the recent World Economic Outlook report, IMF has revised the 2020 global GDP further downwards than previously forecast, as the COVID-19 pandemic has had a more negative impact than was earlier anticipated. Global GDP is expected to contract by 4.9% in 2020 before rebounding back by 5.4% in 2021. Now, I must say that these numbers may get further revised downwards as the pandemic continues. The rebound hinges on the assumption that the rebound for 2021 hinges on the assumption that the health crisis will be contained along with the pace of the vaccine development and its distribution. In India, the confluence of subdued demand, risk aversion, and lockdown-induced supply and demand disruptions threatens to leave the Indian economy with a sharp contraction for 2020. The economic cost of the lockdown has been enormous and higher than anticipated, with significant losses in a number of sectors such as airlines, hospitality, real estate, and retail. India's GDP grew only by 4.2% in FY20 against the earlier estimate of 5%. The fourth quarter GDP grew by 3.1%, reflecting to some extent the impact of the first week of COVID-19 lockdown on the Indian economy. Going forward, consensus estimates predict that India's GDP will be negative in the current year, FY 2021. The RBI has been proactive and has introduced a host of measures, including reducing the repo rate twice since March by 115 basis points to 4%. The previous instance when the repo rate was reduced to sub 5% was in April 2009, which was, of course, during the global financial crisis. RBI has infused an estimated rupees 9.57 lakh crores, or 4.7% of the nominal GDP, so that corporates have enough liquidity and better access to working capital. To augment liquidity in the system, RBI has reduced the repo rate, cut the cash reserve ratio, conducted targeted long-term repo operations, and introduced refinancing facilities. Whilst RBI has done a commendable job in continuing with its accommodative stance, bank credit has not been picking up, especially to the weaker players, as there is so much of risk averseness that continues to remain in the system. Bank credit is hovering around 5.5% to 6% year-on-year compared to 12% in the previous year. On the positive side, as the lockdown measures ease, pent-up demand is expected to unfurl in the coming months, and I'm hopeful, and I think this is more a hope at the moment, that we will witness an uptick in the Indian economy from December 2020. All signs that we are seeing at this moment seems to point at that. Some sectors such as e-commerce and agriculture have performed rather well during the lockdown, and there are some signs of revival in rural demand, blue-collar jobs, and the automobile sector. As regards corporate India, the overall performance during the first quarter of 2020 was weak as was expected. The weak performance was led by manufacturing companies, while services sector companies, especially those in the IT sector, remained in positive terrain. India Inc. is hoping that demand picks up as the lockdown measures continue to ease. Due to the abandoned liquidity in the system, borrowing costs in the financial markets have dropped to the lowest in a decade. Although banks and debt markets are still cautious, liquidity is available for high-quality credit or AAA-rated companies. Lower borrowing costs have led to record primary issuance of corporate bonds. During the April to June 2020 quarter, corporate India raised more funds from debt markets, while equity fundraising plunged as COVID-19 impacted the stock markets. Indian companies raised 2.1 lakh crores via corporate bonds during the first quarter of FY21, which is April to June, compared to 1.67 lakh crores in the same period last year. The COVID-19 pandemic has created disruptions that have challenged the skills and ability of corporate professionals on how to address such a crisis. With so many factors to consider, finance specialists are prioritizing the immediate concerns of the organizations and are analyzing a wide range of scenarios that are likely to happen if the pandemic prolongs. Before I discuss about fund strategies, I would like to articulate the importance of being prudent and how important it is to maintain a proper ALM management. If one recalls, March 2020 was a particularly difficult period for raising resources, as prior to the lockdown announcement, the write-down of Yes Bank's additional Tier 1 AT1 bonds to zero rattled the markets, with yields going higher by as much as 150 to 200 basis points in a matter of a few days. The corporate bond market was severely impacted due to mutual funds facing redemption pressures and heightened risk aversion. In the following month, which is April, 6 debt funds of Templeton were wound down due to the extended lockdown, which heightened redemption pressures and reduced inflows to unsustainable levels. But the problem unraveled itself a couple of years ago with the default of ILFS in September 2018, which created massive risk aversion in the system. Critically, the root of the issue started much before the collapse of ILFS. Between 2014 and 2017, interest rates were by and large low. The yield curve was positive. As a result, many NBFCs borrowed short-term and lent long, which created a classic asset-liability mismatch. The short-term borrowings were largely through commercial paper, which typically had a 60 to 180-day maturity. In view of the short tenure, cost of borrowing money through CPs was very low. Even though borrowings were short-term, they kept getting rolled over on maturity. To give you a sense of the numbers, the amount outstanding in commercial paper increased from 3.73 lakh crores in March 2018 to 5.88 lakh crores in October 18, an increase of 58%. The crisis situation unraveled itself with the failure of ILFS. Risk aversion set in, and suddenly NBFCs were not able to refinance their liabilities on maturity. The problem was compounded when things started changing from early 2018 as oil prices started moving up, putting some inflationary pressure in the economy. Further, there were reports that suggested that 3 or 4 companies which did housing loans had financed themselves through CPs to the extent of 40 to 50% of the total borrowings. As we all know, housing loans are long-term and therefore require long-term funding. Such reports created panic in the markets, and mutual funds, which are the main subscribers to commercial paper, stopped subscribing and also stopped rolling over existing commercial papers, creating a liquidity crisis in the market. I've illustrated this example to caution on how the prevalence of asset-liability mismatch caused such a pain at a systemic level to the entire financial market. Currently, due to the RBI's measures to ensure that there is sufficient liquidity in the system, marginal cost of borrowings have come down, but that is restricted to highly rated or AAA corporates in the financial sector. Lower rated NBFCs continue to face some difficulty in raising funds even today. Positively, spreads on AA plus and lower rated bonds have softened a little bit from the peak that they were in the latter part of March 2020 when the lockdown commenced. Let me now come to HDFC. For HDFC, due to the ample liquidity in the system, our overall borrowing costs on a marginal basis have come down a lot since March 2020. Our borrowing composition is also similar to that of March 20. On a side note, I would like to mention that being prudent is very important to us, and accordingly, we have made sure that the liquidity levels are extremely high. Perhaps we have been over-conservative in this regard. Right through the first quarter of the financial year, which is April to June, we had an average excess liquidity balance of as much as 32,000 crores, right through on an average for 90 days during the quarter. As regards our overall funding strategies, we believe adaptability is key and that raising resources is a dynamic function. It is important to raise resources from a variety of sources and keep shifting funding sources across different channels depending on the economic conditions and the interest rate environment. When there is uncertainty in the market, as is the case now, retail investors typically move away from riskier assets like equity and look for safer investments like deposits and bonds. We are currently witnessing this scenario where retail investors are parking their savings in deposits of banks and the likes of HDFC, despite the extremely sharp drop that we have seen in interest rates. Notably, after the global financial crisis of 2008-9, we made a conscious decision to ensure the deposits need to constitute at least 1/3 of our total borrowings. Though a tad expensive compared to other sources of borrowings, deposits form a very stable source of funding, are relatively immune to the vagaries of the economic markets or economic conditions. I would like to reiterate that in the financial services business profits can be enhanced by taking undue risks, particularly on the ALM front. That, however, creates volatility in earnings. We have therefore avoided ALM mismatches on interest rates, maturities, and currencies. Consequently, our spreads have been relatively stable over time. Matching assets and liabilities, both in terms of interest rate and maturity, as well as managing costs, are some of the challenges that the treasury teams face all the time, particularly in the financial sector. Managing volatility in terms of currency and commodities is also especially important. There is a need to focus on long-term strategy rather than maximizing treasury profits. Hedging strategies should be clearly understood. Several companies have burned their fingers having inaccurately believed that they have devised a foolproof way of hedging. What looked risk-free at one time, in reality turned out to be fraught with risks. As you know, we have gone to the markets recently and raised equity. We have raised equity through two instruments. One was a direct equity, which was of a sum of 10,000 crores. Then we had an overwhelming overnight demand for it. And then we have done a structure where the investor pays 10% of the last market price as an upfront option premium, and as a result of that gets a warrant, and that warrant entitles him to come to us 3 years later or any time during the course of the next 3 years and buy one share of HDFC at a 22% premium to the current market price. So effectively, there is a 10% upfront payment and there is a 22% premium of 22% back-ended premium which comes in on conversion. And both these issues went extremely well in the market. So I believe funding has to be through a judicious mix of debt and equity. Equity brings in dilution. Equity brings in a reduction in the return on equity in most instances, but at the same time, equity gives you much more stability and gives you the currency that you require at a time like this to be able to enter into M&A transactions, which might be available at relatively low prices over the next 12 to 18 months. Let me conclude by saying that CFOs have recognized that there is no getting back to normal anytime soon. Once there are green shoots on the economic revival and signs of stability, the CFOs and senior management will need to conduct an honest review of finance teams, systems, processes, and progress on digitization that have carried the organization through these difficult times. CFOs will need to learn from this experience and emerge stronger so they are better prepared for the next crisis if it ever happens. Unprecedented challenges should not deter CFOs from their long-standing principles. For instance, shareholder value should never be seen in terms of an organization's ability to generate short-term profits, but should always be judged in terms of its ability to manage all the factors which have a bearing on its long-term viability. A CFO needs to ensure strong financial health in the long term, which is essential for future growth. Often short-term sacrifices need to be made in the interest of long-term stability. The role of a CFO has expanded over the years. A CFO is the conscience keeper of the organization. He assists in fulfilling the CEO's vision, complies with the board's directions, and is a strategic decision maker. Finally, I hope and pray that we will soon see the end of COVID-19 pandemic and that our lives will be back to normal. I do believe that there is light at the end of the tunnel. When this is all over, we will look back and not be able to believe that such a scenario happened. I personally never imagined in my wildest dreams that a virus outbreak of such gigantic proportions would happen in my life and completely disrupt the lives of all of us. Thank you very much.
Thanks, Keki, for this delivered point. Of course, you have emphasized that conservative and prudential way of running the organization is the one that will really stand you in good stead as you go along. We will have Q&A. Pranjal, is there any question or should I start with one?
Sir, please start.
Okay. Kiki, I think your analysis has been brilliant in terms of the issues that have taken place and the actions that RBI has taken, the market issues at this point in time. But you also came up with this very well structured, fundraising at this point in time, and you have described the structures that you followed. Is there any lesson to be learned on this? Is there any, in terms of the approach to market, in terms of the instruments that have to be used and so on? Are there any lessons?
See, Maha, what we wanted equity, not because our balance sheet is weak. Our balance sheet is extremely strong. Our Tier 1 capital stands at 16.2% and Tier 2 capital is another 1.1%. So we have nearly 17% capital adequacy. Secondly, if you look at our investments that we have made over the years, we have an investment in HDFC Bank, HDFC Life, HDFC Asset Management, which are the 3 listed companies within the group. And then we have a general insurance business and we have a education finance business. Now, the 3 listed companies that we have, the total amount that we have invested in these companies over time is about 15,400 crores. The market value of these investments on 30th of June was over 2,07,000 crores. So the unrealized gain on our listed investments was to the tune of 1,92,000 crores. So theoretically, it was always possible for us to, reduce our investment by 1 or 2% and raise equity, and that equity would be used in our business. But we didn't want to do that because we believe that there is still a lot of upside that we will get on these investments. We believe that there will be a lot of opportunities that will come our way in terms of M&A transactions, and that is the reason why we needed to raise equity. Again, funding is, as I said, not an issue for us at all. We are carrying 32,000 crores of excess liquidity in the balance sheet. But any investment that we make in a subsidiary or in any acquisition or in any M&A transaction becomes a straight reduction from Tier 1 capital. So it has a direct impact on the capital ratio. It has no impact on liquidity or funding because a couple of thousand or 4,000 or 5,000 crores is neither here nor there. But it has a direct impact on our capital. And that is the reason why we wanted to make sure that we have enough capital in hand to be able to take advantage of market conditions which may come up over the next year and a half in terms of acquisition opportunities. Now, why 2 instruments? The reason is equity is obviously the most obvious example. But we don't want to go to the market every couple of years or every 3 years or 4 years or 5 years to raise equity. We'd rather raise equity now and let that equity last for a very long period of time. So therefore, we did not want the entire 14,000 crores to be received upfront. We wanted an instrument, or we wanted a series of instruments through which part of the money would be received now and part of the money would be received 3 years later. So that is why we chose this particular instrument. We used bankers. We actually had our results on the 30th of July when we also had the AGM. And then we announced this issue. We planned to launch this issue around the 5th, 6th of July. So we had to have a series of investor meetings on the 31st, on the 1st, and on the 2nd was a Sunday, so on the 3rd of August. So 3 days of intense roadshows where we would have done, we had two teams we set up. We would have done close to 30 investor meetings in that period, and all large institutional investors. And for some of the relatively smaller investors, we had group meetings. So the investor meetings got over on Monday. There has to be a 24-hour cooling period after that. So Tuesday we could not do anything, and therefore we had to launch the issue on Wednesday. Fortunately, where markets were reasonably favorable on Wednesday, though I don't know how many of you are in Mumbai, but Mumbai had this massive storm on that day. And it was a bit of a nightmare because our offices got completely flooded. The whole area got flooded. Nariman Point never gets flooded, but on that particular day, Nariman Point got flooded. And the area outside the office got completely flooded, and we had a complete electric failure. But we had to work through the night. to ensure that the documentation got the final touches to documentation were made. The document had to be uploaded on the stock exchange. So all that got done. And then the banker started the call. And by the time it was morning, we were constantly, monitoring what was happening. And early morning around 5:30, the issue was already oversubscribed multiple times. So we shut the issue at 8 o'clock or 7:30, I think, in the morning, 7:38 in the morning. And then had to go through this tedious process of allocating shares, because if someone had applied for theoretically 500 crores, he doesn't get 500 crores. He probably ends up getting only 100 crores or 50 crores or whatever the amount. So that allocation happened, and that was the reason. So we raised equity in 2 tranches through 2 instruments, part of the money coming in upfront, part of the money coming in 3 years later.
Excellent. Of course, you have had the climate problem as well as the COVID problem with this during this time raising money. But there is an interesting question from Jay Sembal, which I'll.
So he can ask the questions also. So Jay can ask directly as well. Jay has rights.
Sure.
Jay, would you like to ask the question?
Sure. Thank you, Pranjal. Thank you, Mr. Mahalingam. Thank you, Mr. Mistry, for a great note. Very good information. I was curious to know, will financial markets see some fundamental changes post-COVID-19? How do you see that?
I think in the short term, there will be challenges that the financial markets will face, because a lot of people in the sector to risky assets, to people in the economy who have suffered, whose businesses have suffered or whose jobs have suffered. So you can see an inching up of non-performing loans in the financial sector in the short term after the moratorium is lifted. The restructuring that RBI has permitted will help, but it will not be sufficient in my view. It will help a long way. Let me correct that statement. The reason I say that there will be a lot of cases where people will, even though they need a moratorium, need a restructuring, the lenders will not be able to provide a restructuring, because RBI says that restructuring is possible only if the loan outstanding from that customer, the installment outstanding from that customer, is 1 month or less. Now, there will be many instances, where the outstanding is more than a month. It could be 1 month, it could be 1.5 months, it could be 2 months. And those cases will not be entitled to the restructuring. Our suggestion to RBI would be that anyone who qualified for a moratorium should automatically qualify for a restructuring. Restructuring would only be required in sectors which have been badly impacted because of the COVID-19 situation, whether it be employees of airlines or airlines themselves, whether it be hospitality sector or employees of the hospitality sector, or it could be hotels or employees of hotels or things like that. So if they've not been getting revenue over the last 3-4 months or 5 months or whatever it be, then how would they be expected to pay off a liability which is maturing, or a working capital loan from a bank which is maturing, let's say, in the month of September, when the lockdown is lifted? So there will be some challenges that the financial sector will face, but I think these are temporary challenges. A lot will depend, in my view, on the strength of the balance sheet of the lending institutions. I think most lending institutions have, over a period of time, developed or made sure that they have a reasonably strong balance sheet. So short-term challenges will be there. Medium to long-term, I think things will come back to normal.
Thank you, sir.
Sir, I think Tanushree has a question she can ask.
Good afternoon, everybody. Thank you, Mr. Mistry. That was actually very, very insightful into what led HDFC to do the fundraising. I think the question I have is more about the smaller NBFCs that exist today. So, larger NBFCs and larger corporates by that token have always had access to capital. In the context of NBFCs, there are smaller NBFCs which have been serving the more underserved or unaddressed market. And, ever since the IL&FS crisis, capital for them has been scarce, despite the ratings and the well-managed books that they may have. And COVID has only exacerbated the situation for them. What's the view that you have for the smaller NBFCs going forward? in terms of not just capital being available, but how is this sector of the economy going to shape up, and any resulting consequences on the customer base that they address?
See, my sense is that the problem with the NBFC sector, when I mentioned that when I spoke also, came up in that period from 2014 to 2018, pre-ILFS. That period saw many of the NBFCs getting listed and trading at very, very fancy multiples. So multiples of 5 times book, 6 times book, 7 times, 8 times book was not uncommon. And many of these NBFCs took huge mismatches in their funding. They borrowed short, lent long, and created a classic asset liability mismatch. They managed to multiply their profits every quarter, every year, by virtue of the fact that every time they went in for a renewal of their borrowing, the rollover came in at an even lower cost because all the time interest rates were coming down. So that was the kind of situation, and in that situation they created this huge short-term funding, long-term liability structure. So the risk averseness that came in post ILFS resulted in everyone not wanting to lend money to the weaker NBFCs because people said that they are running into a huge problem. The liability structure is a question mark. They were all growing at rates of 40 and 50 and 60% a year. So that asset side problems will sort of start showing up over a period of time. That risk averseness hasn't gone away even today. It has probably reduced. It had reduced a little bit. It came back during the COVID, early part of the COVID situation in March, April, May. But I think let us also compliment RBI. I think RBI did a very good job in trying to ensure that liquidity was provided to weaker segments of the market. So RBI, for example, provided funding which was directly aimed at to these LTRO programs where banks had to necessarily use that money only for lending money to NBFCs or to housing finance companies and so on and so forth. So the extreme situation of fear and inability to get money at all, which prevailed in March and April, to a great extent has gone away. I think these NBFCs will have to start looking at securitization in a big way. You cannot just keep building a balance sheet because if your borrowing cost is going higher, you have to lend money at even higher rates to be able to make money. And the higher the rate at which you lend, the more the risk you take because you're lending money to a segment of the market which is generally perceived to be weak. So they have to learn to start selling their assets. But these phases pass over time. I mean, this is not the first time something like this has happened. Maybe this has been more intense. It has lasted a much longer period of time. But these kind of issues have happened even historically. So I think over the next couple of years, hopefully, once the economy comes back to normal, these smaller NBFCs can also be able to get funding. But today, I think their strategy must be they must be originators of loans. They should have a good distribution platform. They should originate the loan and then securitize the loan or sell the loan.
Okay.
Thanks, sir. Thank you. So, Mr. Seshagiri Rao is here in case you'd like to add anything. Otherwise, we can move to the next part.
No, thank you very much. That was a very insightful speech by Keki. Thank you very much. I have nothing to add.
Right, sir. Thank you.
Okay. Yeah, thanks, Keki. I mean, we will close your program at this moment in time. I'll now hand this over to Saurabh. Saurabh, of course, as I said, Saurabh Jain is the CFO board and he's the Chief Financial Officer of National Investment and Infrastructure Fund. Along with him, we have Manish Agarwal, Head of Energy and Infrastructure M&A Special Solutions Group of KPMG, and then we have Mr. Kishore Desai, Principal Strategic Initiatives and Policy Advisory, NIIF. So let me hand it over to Saurabh now.
Morning, everyone. Thanks, Mr. Mahalingam, and thanks, Sir Keki, for this valuable insights on the macro. So for the next half an hour, the way we have structured our discussion is that I'll continue on the macro piece from the conversation which Mr. Keki had, briefly talk about where we stand as of today in terms of the economy, what are the avenues available for financing both internationally as well as domestically. And from there on, I'll pass on to my colleague Kishore, who is part of a strategy and policy team in NIF, and he works extensively with government in innovative infrastructure financing ideas. And then Manish from KPMG will take over. Manish, again, he also works extensively with government on various infrastructure-related initiatives and infrastructure. We know that national infrastructure pipeline of $1.3 trillion, and how the government is focused on that. So those experts will be covered by my colleague Kishore and Manish. So first, I'll just start basically with more of a macro view in terms of how do we stand or where do we stand in terms of a Vision 25, which basically we were aiming for a $5 trillion economy. Now, this obviously, if we go by where we stand as of today, this looks obviously unrealistic. But if we look for a more longer term kind of a projection, where we will be into 2030, and which basically forecasts us to be a $6.5 trillion economy, probably looks much more realistic. And I think that's where all our reforms and all our efforts have to be targeted. Actually, 5 million is something which probably will be out of the picture very soon. Coming back to this now, obviously the key levers for this, which I would like to cover briefly today, is on the labor. Again, these are factors of production as well: the labor, capital, and the entrepreneurship. And obviously, we'll spend more time on the capital, considering the agenda of the webinar today. So if I start with the labor, actually, which is something obviously we hear and we basically know how we stand in terms of the demographics in the country. Now, this basically shows where India will be in 2030. So by 2030, close to 1/5 of the world's working age population. When I say working age population, means population between age 15 to 64 years will be Indian. So basically 1/5 of the world's working population will be Indian. We will have almost like 1 crore of incremental working age population every year. Our median age will be 28, which is 10 years below the China's median age. And I mean to say, with all these demographics, if we are not able to become the supply chain of the world, then I think there's something definitely wrong. So there are tailwinds in terms of demographics, and hope our reforms measures continue and we can build further on this. Now, if we look at the capital part of it, now India actually has been ranked 9th in 2019 in terms of the FDI inflows. So India raised close to $51 billion, and this has been like a 20% growth over 2018. So over here as well, if we just look at the how the fund LPs perceive India actually, so it's not, I mean, it's not bad actually. We are doing well in terms of the attractiveness to the foreign investors. So we actually are ranked 3rd in terms of the attractiveness to the fund LPs, which obviously is again one of the points which we need to build upon. So I've covered the labor, I've covered the capital. Now let's look at the entrepreneurship part, which obviously these 3 are the key aspects for any growth in the economy. If you look at the ecosystem of startups, so India is actually the 3rd largest startup ecosystem in the world. Now basically, if you look at 7 years, our tech startups have grown by close to 35%. And at end of 2019, we had 4,500 tech startups. Our unicorns at the end of 2019 were 27. The flip side to this is that out of all the unicorns which have been founded by Indian entrepreneurs, 2/3 of those unicorns are actually based out of India. So just an unfortunate thing that only 1/3 of those unicorns are in India and 2/3 are outside India. So obviously something needs to be done to attract those entrepreneurs into India as well. In terms of the internet users, At 2018, we were 464 million users. This number as of today stands around 560 million users. If you look at the people who have funded these unicorns, out of the 27 unicorns, SoftBank have funded 9, Alibaba has funded 5, Tiger Global 5, Sequoia 4, and DSC Global 3. So most of these unicorns have been funded by SoftBank. So basically, now if you look at that on the labor side, we have good leeway versus China. On the capital side, the foreign fund LPs see us positively. On the entrepreneurship side, we are growing. We are already at the 3rd position. So it's not basically all doom and gloom. Obviously, there are headwinds in the short term, but if I look from my perspective, there are obviously tailwinds in the medium and longer term. How we leverage those, how we continue on the reform path will decide upon where we end up in 10 years' time actually. Now, if we look at the sources of capital actually, and before we jump into it, a quick snapshot of how investment rate has been doing in India. So obviously we have not been doing pretty well on the investment rate. We have gone down from a 39% investment rate to 33%. And this is a reflection of reduction in the household savings or the saving rate, gross saving rate. Thankfully, the FDI, which was like 2% of the GDP as at last year, has plugged in the gap, but obviously more needs to be done. Niti Aayog actually has put up the target of 36% investment rate for by financial year 22. Now, to achieve that kind of investment target, obviously a saving rate has to go up, and we need to supplement that by FDIs. Now, in terms of the foreign capital, who have been the most aggressive players in terms of putting money into India? So, if we look at this information, now India, the FDI primarily in the last few years have come from the private equity and venture capital funds, and as of end of 2019, almost like 1.7% of GDP was funded by this foreign private equity and venture capital funds. So they invested close to $48 billion in 2019, which effectively, I mean, if we take out the 10% of which was the domestic capital, it's almost close to 70% of the overall FDI we had in India. So which basically shows that this is actually a very good source of capital. As per the latest data which IVCA collected, there's close to $80 billion of dry powder available with private equity and venture funds, and that capital is actually available for India. And $80 billion obviously is a huge sum of capital. So there has to be some sort of an incentivization for these PE and VC funds to make them invest that money at a faster pace. So there have been certain recommendations which have been made in that regard. I'll touch upon that subsequently in my slides. Now, if we look at the other source of foreign capital, this is sovereign and pension fund. Obviously, these sovereign and pension funds have the largest capital in the world available with them. And having them actually on board is basically advantageous for the ultimate company, because they bring in the highly patient capital. They're not looking at a 4 or 5 year window to exit. The expectations they have on the returns are realistic, so it doesn't put too much pressure on the company to grow at a faster pace and compromising on basic things. They help bring right governance frameworks in the company, which again helps them in the long run. And having a sovereign or a pension fund as one of the shareholders in the company actually significantly helps in the fundraising. Now, we have seen that in NIF, and we started the NIF, basically it was incubated by Government of India, and we had a first investor, global investor, ADIA, Abu Dhabi Investment Authority, coming in, which actually helped us to attract a lot of these global pension funds and the sovereign funds from Singapore as well. So it basically is something which needs to be built upon, and government is quite conscious of this fact. What they have done in the recent financial budget, they have given the tax exemption to the sovereign and pension funds for any investment they make in the infrastructure sector or between 2020 to 24. And this is something which obviously has probably will have a significant uptick on their returns. And we hope to see a lot of capital coming from these sovereign and pension funds in the coming years. Now, if we look in terms of what are the sources of funding in the domestic economy, now this huge pool of capital available domestically as well, and something which has not been focused so far, and it's probably the high time that we start looking at these avenues as well. So I've shared a couple of examples on where we can tap into, and this is something which we have been working with EPFO as well. So EPFO as of today had a close to $170 billion of corpus. And with a growth rate of 16%, what they have witnessed between the last 7 years, actually, they would be $500 billion by 27 and $1 trillion by 2034. If you look at their investment profile, the investment profile is ultra conservative. Most of this money goes into the government securities and debt securities. And there are a lot of restrictions for them to invest into equity or alternative investments. So there is a proposal on the table for them to open up and invest more in the equity, invest more in the alternative investment structures. So basically, that domestic capital can be leveraged in a much better manner. There's something, obviously, they have to be cognizant of the fact these guys look at stable returns and yields. But having said that, actually, there are examples across the globe that the large pension funds like CPBIB, CDPQ, all these Canadian and Australian pension funds, they do invest significant parts of their capital in these alternative investment funds. So this is something which obviously is under discussion. As I said, this will take a bit of time because there are complications in terms of the board which looks after the EPFO. There are trade union representations. So all these things have to be factored in, but it's obviously something which should be dipped into in terms of getting the right usage of the pool available for investment. The second thing is the bonds market. Again, the bond market in India is not matured in the manner which obviously a lot of us would have expected it to be. So if we look at the bonds market as of today, it stands at 14% of GDP. And if we compare with China, which is like 31% of GDP, there's a lot which can be done over here. Now what can be done? Obviously, some steps have been taken by the government in terms of VRR scheme for FPI, which again I'll touch upon briefly subsequently. But if you look at like why the money is not coming into the bonds market, obviously is that when the market doesn't exist as such, there is no liquidity for the bonds. And if you look at the household savings, which is on the right side graph, actually show that most of the household savings are going into the physical assets. And if we are able to encourage those household savings into the financial assets, we'll obviously see this bond market developing fast actually. I mean to say, there could be bond issues by infrastructure-related companies. There could be tax-free bonds, and government came with these tax-free bonds 5 years back, 4 or 5 years back, which were lapped by all the high net worth individuals and corporates. And these kind of bonds actually is something which they should tap into so that people can move from more of physical assets to these financial instruments. Now, if you look at the regulatory reforms, which basically which have happened over a period of time, ease of doing business, all of us are aware of that India has moved significantly in last 5 years. But having said that, there's still a significant scope actually in one of the areas where all the multinational, all the foreign investors are quite like apprehensive of. That is the enforcement of contracts. So this is something which will require a lot of hard work, and again, there's a consciousness in the minds of the people in the government that this needs to be kind of something which they need to focus on and bring it the rating at a much higher level. which will provide necessary comfort to all the foreign investors. In terms of the tax, obviously we know the tax rates have been aligned. We are basically comparable with some of the emerging economies, and the disadvantageous position which we were in until last year has been removed. Now, if you look at the recent reforms which have been done in basically to attract capital, first is, as I spoke about, the tax exemption to these pension and sovereign funds on their infra investments, which should see significant amounts of capital coming into the infra in the next 4 years. DDT again has been pretty helpful. That withholding concession on the ECBs, they have extended till 23, which again is helpful. Corporate tax we touch upon. IFSC, which they've started focusing now, this should have been done long time back. Unfortunately, there is only one IFC as of now, but there's a proposal to set up more IFC in the country to attract foreign investors to establish their base in India. The VRR scheme, which basically which allows FPIs to invest in Indian debt market and close to $20 billion window, which again should help in deepening of the bonds market. The ECB regulations have been rationalized, so the end user restrictions and the framework which put restrictions on recognized lenders have been diluted, which is helpful. So it should see some sort of debt coming into India with these last two things. Certain recommendations which we have been making, and again, this is something which it's not up on the agenda of the government, but it's something which they should typically focus on, and to get all these PE and VC funds and the foreign investors into the country. First is this, if you come through an FDI route, you cannot invest in kind of a quasi debt structure. So you can only do it in a kind of a compulsory convertible equity structure, which at times doesn't work with this private equity fund, because they obviously want to protect themselves, and for them the optionality works. And in addition, they also look at the call or put options, which are all available across the globe. India, they are not available, and as of now they have only made these available under the FCCI route. But FCCI route, again, the second point which I am going to talk upon, is restricted to very limited set of sectors. So there is a recommendation that if basically they can allow more sectors to come under the FCCI route, which will allow these kind of quasi debt structures, and basically provide a lot of comfort to the investors who come and invest in the companies. Then the other suggestion which has been made is the pricing guidelines. So one of the suggestions has been taken into consideration that from 26 weeks they have moved to 12 weeks for the listed shares. But again, the window is only open till December. The suggestion or the recommendation has been that as of now we have pricing guidelines under SEMA, there are pricing guidelines under SEBI, and then under the Companies Act. So we should have one set of pricing guidelines so that there are no conflicts. It simplifies the job of companies, and then basically simplifies the way which foreign investors come into India. The next point is more related to the domestic capital. As of now, insurance companies, pension funds and banks, they have limitations up to which they can invest in the alternative investment funds, and which basically is something, if these restrictions are removed or the amount, the thresholds are increased, all these large banks like SBIs and these pension funds, insurance companies, they can create their fund of funds, which obviously will kind of create or mobilize the domestic capital for further investment into the country. The other recommendation has been that there is an interest ceiling prescribed under the FPI, that if the interest rate is beyond that rate, then the withholding cannot be 5%. So again, the interest rates is subject matter of commercial negotiation between the borrower and the lender. So the recommendation has been they should take away this kind of a limitation and allow that to be a more of a commercial decision. The suggestion made has been that all these PE VC funds, if there's a window which basically allows that whatever investment they make for a particular period of time that is not subjected to a long-term capital gain tax, then we'll be able to attract this $80 billion capital into the country in probably next 2-3 years. And whatever loss which government might face because of this long-term capital gains tax will be more than covered with the increase in the economic activity with this capital coming into India. Again, but changing the taxes thing is not easy. This is again a recommendation which has been made, and we hope they look into it. The last thing from my side is the PN3, the FEF Note 3, which came in April, which basically restricted the border countries to invest into India, in a sense that every investment for the border country has to be routed through a mandatory FDI approval route. Now, suggestion has been made that they should set up some sort of a threshold that could be a 10% or 25% beneficial interest threshold, which simplifies, because a lot of these PE funds coming into India, they might or might not have Chinese investors into them. Now, even if the Chinese investor hold 1% in that fund, when they have to invest into India, they have to go through that FDI approval route, which again is a long drawn process. So recommendation has been made that they come up with some sort of a threshold limit which simplifies, provides clarity to these international investors. So hopefully some of these recommendations do get implemented over a period of time, and we are hopeful that it will help getting the necessary foreign capital into the country. So with this, what I will do is I'll pass on to my colleague Kishore, and just to introduce briefly, he used to work with Niti Aayog under Mr. Vivek Debroy, and he joined NIF a couple of years back, and he works extensively with the government on infrastructure-related policy initiatives. And we as NIF have been working extensively with the government on the National Infrastructure Pipeline. And Kishore will talk about that, and then Manish will build up further on those things actually. So I'll pass on to Kishore.
Yeah, thank you, Saurabh. Am I audible? Hello?
Yes, please go ahead, Kishore. We can hear you.
Yeah. So first of all, thank you so much, CFO board, Pranjal, and the organizing team for giving me this opportunity to share my perspectives on this topic in front of the August platform. So Saurabh already has introduced me, but I just wanted to make two more points. So I have been a student of public policy and infrastructure sector since quite some time now, and I have keenly tracked developments in these spaces for more than 15 years. And more so when I was OSD in Niti Aayog and Economic Advisory Council to the Prime Minister, worked with Dr. Vivek Debroy. I got an opportunity to actually work as an insider within the government, and I got that experience of how policy is made, what are the factors that governments consider while making policies, etc. So I'll be wearing these hats while I share my perspectives. So what I'm going to do in the next 10 minutes or so is I wanted to make three broad points, and I will also substantiate those broad points with some specific examples as to why I'm saying whatever I'm saying. So let me start with the first point, and I think all of us have alluded to this. Essentially, COVID has sort of derailed the trajectory of economic path of the country. But having said that, what we are noticing since the last few months more, but generally in the last some time, that the government is actually implementing a very serious, and I'm not saying it's not a half-hearted effort, it's a very serious effort to sort of bring the economy back on track and to bring back private investment. Now, why I'm saying this? I would sort of substantiate this point with 5 specific examples. One, the release of National Infrastructure Pipeline. Now, this is a very ambitious, I would say, vision of the government. If we see over the last 6 years, between FY14 to FY19, the total investment in the infrastructure sector was around 50 lakh crores. However, now what the government is planning is to double this investment, roughly more than 110 lakh crores in the next 6 years, from today till FY25. So what they have done is they have released this national infrastructure pipeline, which is sort of a vision of the government as to how should India's infrastructure look like from today till FY 2025. It is essentially an annual pipeline of infrastructure projects which the government plans to implement every year, starting this year. So what does it mean for investors, for private sector, and for government also? So for investors, essentially what it means is there is a clear, upfront, transparent list of projects that's there for everyone to see. And for investors, it gives a platform to digest the list of opportunities, the bouquet of opportunities that is likely to come in the next 5 to 6 years. And then they can plan their way forward accordingly and track more closely those projects where they want to invest. For the government, essentially it gives them a lever to plan backwards. So essentially, it's putting it's putting the onus back on the system of governance that look, now the government has already committed implementing these projects in a time-bound manner. Now they need to plan it backwards as to how do we solve for those integral components. When should land acquisition happen? When should those clearances, forest clearances, environment clearances, etc. should happen? When should those feasibility studies be done, etc., etc. So to go about this infrastructure investments in a very planned and a systematic manner. So that's one part. The second part is also there are several loops to, I would say, loose ends to this entire story. So, one of the questions that we always think, we're talking about 111 lakh crore pipeline. Can we actually get capital? Can we actually finance it? So that's the question. So it gives an opportunity for the government to actually examine in a very detailed manner as to how do we ensure that the adequate funding to this extent is really available. Then are our regulatory systems, governance systems adequate enough to ensure that the implementation happens smoothly, or do we need to change things? So I think those. So it may require some reforms, some new policy measures, some tweaking of existing policy measures, so on and so forth. So overall, the infrastructure pipeline is a very comprehensive document which helps the government to tie all these loopholes, and it has been made public. There have been 3 volumes which have been released. And I think it's a very bold statement that the government is upfront willing to make it to the public and to the investors. So that's the first point. The second point really relates to the taxation bit. Saurabh has, I think, covered this in a fairly detailed manner, so I won't be repeating. The third point essentially relates to monetization. And so, see, we have been actually hearing since, I think, quite some time now that it is not government's business to stay in business. And I think this is the first time when the government is really trying to take that, to do something about that in a serious manner. So they are adopting 2-pronged strategy for that. First is monetization of existing assets. So government already owns significant amount of operating stable assets in the infrastructure sector. So there are pipelines, there are transmission infrastructure, there is railway infrastructure, there is airports, roads, etc., etc. So government is trying to come up with a clear roadmap, a plan for monetizing the assets, and we know that it's under works, and we should expect a 5-year asset monetization pipeline very soon. So that's one. Second, as part of the Atmanirbhar Bharat package announcement, the finance minister herself announced that the government will come up with a clear policy for public sector enterprises. And there are more than 250 public sector enterprises, and not all of them are profitable. And I think the government is clearly trying to come up with a framework wherein for public sector enterprises which are in so-called strategic sectors, government will ensure that that the number of public sector enterprises are not more than 4. And for sectors which are not strategic, the government will divest, and the government will ensure that private sector gets opportunity to work across both strategic and non-strategic sectors. So that's the second strategy with the government is. So overall, what the private sector should expect is a good, healthy pipeline of public sector companies, healthy companies for strategic disinvestment / privatization. The fourth point, again, I think this is something that we are seeing. Government is trying to majorly push and incentivize manufacturing ecosystem in the country. So they have come up with this production-linked incentive program. It's a very interesting program where through fiscal incentives, they are trying to incentivize private sector for setting up manufacturing factories. And right now the PLI scheme is available for few sectors: electronics, APIs, and medical devices. And in fact, just I think a few weeks back, there have been reports that a lot of large electronics manufacturing companies, those companies which manufacture Apple products, which manufacture Samsung products, have applied for this. So I think that's one. Of course, FDIs, etc., have been published, and there has been a clear institutional mechanism to ensure that any problems in terms of investments from either domestic institutions or foreign institutions is taken a note of and is resolved through creation of project development.
Kishore, sorry, Kishore,
yeah.
What we can do is, if you can also share this presentation with all of us later, and you could sum up now, I'll request my, because then we'll have some time for Q&A.
Yeah. So maybe I'll just go to the last slide. The next one, please. Next one, please. Yeah, I think just these are the 2-3 points which I wanted to make from the investments side. So I think what the government is trying to do, and this is the last message that I would like to give, is government is trying to create products, different products for different classes of investors. So I think Saurabh has already mentioned that for pension funds and for sovereign wealth funds, which would typically prefer to take exposure to de-risked opportunities, asset monetization, disinvestments, etc., are being created. But for greenfield projects, which are slightly more riskier compared to brownfield opportunities, what government is trying to do is government is trying to incentivize the domestic capital, the pool of domestic capital, EPFOs, PFRDAs, etc., and talks are on, and those things are being tied up. Similarly, several other sectors are being commercialized, so passenger train operations, coal mining, etc., etc. So I think overall what the government is trying to do is to treat each problem in a specific manner and offer specific products for different classes of investors. So that's all, Pranjal. I could go, in case if anybody has question, maybe I can address a bit later. So we can pass on to
thanks for this, Kishore. If you send us this presentation, we'll share it with other participants.
Absolutely.
So I guess over to Manish, please.
Thanks, Pranjal. Thanks, Kishore and Saurabh. I think maybe to leverage the best from the time that we are left with, I may not talk about more on the infrastructure side, but let's pick some of the financing side and the post-COVID sort of a stuff, and just linking with the link that Mr. Kiki actually mentioned in the first session. There are few sort of an alternatives which is coming up. If you look, because you get diluted, the valuations today may not be the best, but then it provides a more sort of a stable sort of a comfort zone from a company sort of a borrower's perspective. Now, if you look at what is happening is, I think I strongly feel that a post-COVID world, the one element which was not there much so far has crept in, which is the uncertainty. Even if the vaccine cure comes in, you start see the revival of a growth as everybody is expecting, let's say by December or by early next year. But the element of that uncertainty, because this can actually lapse, nobody knows about that, as we walk through, will always be sitting with us. Now that element of uncertainty brings in obviously an element of a risk. If the investors or anybody look at around, which is very difficult to sort of walk over till the time we really settle out for the next 3 to 4 years. And therefore, as a CFOs of the financing sort of a community, the biggest challenge obviously is to plan for that uncertainty element to it. What we are seeing in the market as a practitioners, and we have been involved in a lot of this stuff, and Mr. Kiki also talked about the one-time restructuring scheme. There was earlier June 7th circular by RBI. There is a pool of capital on the credit side, which is called as a stressed or a special situation funds that we have seen in the market. And the pension sovereign funds is another set of a private equity as well as a pension sovereign fund, which Saurabh talked about as well. So different pool of capitals, which we have seen. Having said that, I have seen over the last, let's say, post-COVID happened, few months was like, a very, very uncertain, very, very sort of sharp views on what happened and people were still figuring out. Maybe over the last 1 or 2 months, I still feel that a deal side, the pure equity deals today are far and few. And the valuations, I mean, the deals that even we were working on, valuations have come down because the investors or even the buyers are really pricing this uncertainty risk, which is a very unknown factor. And because of that, the sellers or the fundraisers are finding it tough to work out. I mean, they don't lose too much of a value. Now, in some of the situations, we are able to do through a structures. In some, it is very, very difficult because the base value itself becomes uncertain. If you look at from the debt side, and I think, again, I would say that the 3 categories of borrowers that we are seeing, and the strategy obviously is very different for each one of them. One largely, which is most part is just a cash flow sort of a problem. I mean, it is not sitting on a high capital sort of a debt capital structure or cap stack is more or less fine. The debt is not very high. The business has been very, very strong. And because of this sort of a disruption, maybe they're just looking for a little bit of a match between the cash flows and the repayments that comes in, or a little bit of a liquidity side, working capital sort of a thing. And therefore, I mean, on that side, at least we have seen the banks have done quite a decent amount of work to touch base their policies around to provide that working capital support. RBI provided that flexibility, and now with the one-time restructuring scheme, which is more targeted, as Mr. K.K. Mistry also said, to those sort of corporates which are fundamentally very strong and is genuinely impacted by this COVID sort of an environment. And RBI scheme provides for up to a 2 years moratorium, and therefore they can actually mash their cash flows with the repayment obligation that they will have. And by the time, hopefully, the economy settles down and the things will be back to normal. So that's one set of categories, which is a little easier side to my mind, post coming of this one-time restructuring. The second category, which is a challenge, which is actually where, you can't say that it is primarily because of a COVID-related stress. They had a capital structure issue as they were walking into, or we walked into this COVID environment, which actually become a very more compounded on a adverse side because of a COVID issues. Now here is the challenge because this one-time restructuring scheme excludes that sort of a company unless and until you are within that 0 to 30 days of overdues, which is SMA 0 as the banking system defines. Now, if you are not in that category, this doesn't apply, and you have to go back to the only instrument available in the banking system for a capital correction, which is a June 7 circular of RBI, which I think even if you look at pre-COVID environment, has not been very successful. When I say not successful means not many restructurings have got done. So that's a little tricky one for the corporates, I mean, to look at that how they want to align their capital structure. Because what we are seeing in some of the work we are doing with the borrowers or some of the deals that we're working, while there's a debt pool which is available, which can come in if you don't target, let's say, the banking system because of the norms that RBI has on the restructuring side, and the banks are more worried about the provisioning hit actually. So on one hand, while they have a liquidity, they are actually not lending the credit side of a play. And on the restructuring, they are averse because the provisioning requirement is high as per the June 7 circular, and that will provide a good amount of a hit. And they are also worried that if they allow sort of a few cases, I mean, everybody will ask for a restructuring. So if you go for a other pool of capital available, then the challenge is the cost. Because one thing which has happened also post-COVID is that the cost of funds of these pool of capital have also increased. So that's a second category which has a challenge as to how they get the capital structure aligned. And in that case, I still feel, my personal view, even if the equity side, you may not get the right sort of a value, rather than going for the expensive cost of capital and raising a further debt, it still makes sense to see what is the non-core assets, what can be disposed of, and to raise some of an equity. Because I strongly feel that unless and until some of the equity comes in, the pure debt solutions may not work in the current sort of an environment. And then I think there are a third set of borrowers of the companies that we are seeing where fundamentally business has impacted a lot. Very difficult to see that when the survival sort of happens, they don't have a money to sort of come in. Promoters are not willing to put in more equity, and the debt capital will be expensive. And therefore, you have to really see what you want to do or whether you can continue in some of the form of businesses as well. So I think different sort of a extent of a capital structure determines what kind of a solution that you can target. And from the government side, just to add to what Kishore was saying, the additional part is two things we are trying to push the government for. One is this asset monetization. It is very, very important because government, as far as government is concerned, divestment has really going very slow, likely to affect a lot of companies which they were targeting. And second is the tax collections has been not that great, which was expected line. So I think we have been saying that the long patient capital providers, the assets which are brownfield, which is something that these investors like, that's the only way the government can actually monetize, raise resources, which is what they require to start, let's say, priming the economy or whatever they have to sort of do on spending resources on some of the other sort of commitments they have on the budget side. Second is that we are also, I mean, as Finance Minister did say last week, you would have heard about a long-term financial institution, DFI being talked about. I think one other thing which the market has seen, and this is more true for infrastructure, which has a lot of how do I say, I mean, linkages with the rest of the other sectors to start reviving and having the ultimate impact on the economy. That with the NBFCs in their own challenging sort of a zone, banks are more or less sort of a withdrawing from our infrastructure, or even in the past they were not giving a long-term sort of a funds for infrastructure projects to go. While the equity may still be available, that the challenge still remains is on the debt side. Where is the long-term debt available for matching with the concession period that we have seen, even if it is 20 years, or now we are seeing 30 years or 40 years concession as well. And therefore, there is this serious discussion going on whether we need back those financial institutions which at one point in time existed and then all got converted to banks because of obviously a lot of failure, and the reasons were very different. And then we are talking of, again, a long-term institution which can give you a long-term financing, which ultimately can get some of these projects going. So I think that's still in a discussion sort of a mode. But if that happens, we are obviously having a view that it should not be just limited to infrastructure, but the industrial sectors as well. If you look at old IDBI or ICICI days, they used to finance not just infra, but a cement, steel, and some of the core sectors, which were very, very important as well. So that's another point that I thought I will share. So to Pranjal, I think I have made some of the points, and then happy to have a Q&A.
Right. Thank you, everybody. Mr. Malingam, over to you, sir. Any questions? And if you have, and anybody else who has questions, please post it, and we'll take them right away.
I think, we had three extremely interesting presentations or discussions and so on. Saurabh, of course, has laid out the complete scenario that we find now, including the funds coming in and the type of funds and all those. I have one question for Saurabh, more in relation to the infrastructure projects and so on. Of course, both Kishore and you have covered it extensively. But are they taking off from a project sense? I think from an intent sense, from a policy sense, there is a lot of work that is coming in. But from a project side, are we seeing many of them really taking off?
So, Mr. Malingam, Kishore, will you like to answer this one?
Yeah, Saurabh, let me. So I think, Mr. Mahalingam, you are right from that angle. So see, I think last week only the government released the list of projects. But having said that, I think we are expecting a delay of about 6 to 8 months in this pipeline. So the projects which are supposed to take off should have taken off by now. They haven't taken off, to be honest. And the government knows it. COVID has sort of disrupted those things. But I think what the government is trying to do is through the mechanisms like project development cell and through setting up a clear empowered group of secretaries, which is headed directly by the cabinet secretary, they are trying to give that institutional rigor of monitoring. So we expect, that in the next 6 to 8 months, projects will definitely take off.
And just to add to what Kishore said, Mr. Malingam, actually this national infrastructure pipeline remains their topmost priority actually. So as Kishore said, there are interministerial group of secretaries which have been formed for this purpose, and they are actually giving the updates to PMO on a fortnightly basis. So this remains a high focus area. Obviously, there has been delay, but hopefully they make some sort of a cover up on this in the next few months.
One more question that I had between you two, or even Manish can take that. In this, I thought one of the key imperatives that the government was following was a public-private partnership feature in the infrastructure space, because that is very critical in terms of the manner in which there'll be some part which will be government owned and some part will be private owned and so on. Is what kind of experience do we have in that, and is that lending itself to scaling up?
Can I come in, Saurabh?
Yeah, sure, Manish, please do.
So, I mean, that's a very fundamental sort of a question as to why I think infrastructure probably is in the stress that we see today, and why I think your first question as to why we are not seeing that much of a pickup or an appetite within the private sector, at least in India, domestic private sector, to really go about infrastructure projects. I think, so what has happened is, I mean, unfortunately, the Kelkar committee, which I think to my mind did one of the best jobs on the PPP side, and came out with a very, very good recommendations. Unfortunately, we have not actually implemented most of them. So what we are doing is, after this NIP was done, I mean, I'm part of one of the subgroups where we have actually picked up some of those recommendations and said that there's no point to reinvent the wheel. It actually has done a lot of fundamental jobs across every aspect of PPP, and why don't we get it going? So I think there is an effort which is being put to just see what can be done on the PPP side. Otherwise, I think my own personal view, and this is my personal view, whatever the government is talking, whether it is NIP or others, the PPP projects per se, unless and until you do this structural reform, is not going to really attract what it is meant to be, or what is the potential which can actually be attracted. Saurabh, you may want to add, or Kishore.
I think Manish has covered adequately. Kishore, please go ahead.
Yeah, I just wanted to add one more point to that, to what Manish said. So, see, I think the Kelkar committee recommendations have not seen the light of the day as of now. But what the government is trying to do are two. I mean, further to what Manish said, there are two more things that the government is doing. One, they are trying to use maybe road sector as a base. So PPPs have worked in road sector to whatever extent. I mean, that's an example where they have worked to some extent. So they are trying to use the learnings from the road sector, and they are trying to overhaul the contractual framework. So, those RFQ documents, those concession documents, those RFPs, etc., for other sectors within infrastructure. So that's one initiative that's on. And second, particularly and this is more relevant for social sectors like education and healthcare, they're trying to put more incentives. So they have increased the VGF, the government support, so that private sector actually gets incentivized to invest in some of these sectors as well, besides the traditional economic sectors. I just wanted to highlight these two more, I would say, initiatives in that regard to incentivize more PPPs.
Right. Thank you. Sir, maybe request you to summarize and close.
I think, this has been a very interesting second session as well, because, we got a complete view of the manner in which India is looked at as attractive, the issues that we have, especially in terms of contract enforcing, and the potential that exists, and the approach to infrastructure. And of course, Manish covered the overall scenario from a financing perspective. So starting from Keki is starting with the cash is king kind of concept, and ensuring that the good organizations don't find it difficult to structure and get the money, to the evolution that is really happening in the financial markets and how we are progressing. I think this has covered a big range of issues that have really come in. Thank you very much, Saurabh, Kishore, Manish, for an extremely interesting presentation. So with that, I will conclude, and Pranjal has already talked about the next webinar on consumption-led growth, being led by another of our CFO board member, Dipanjan Basu, and this is going to be somewhere in the middle of September for our next webinar session. Thank you very much for participation.
Thank you.
Thank you very much. Thank you, sir. Thanks so much for sharing this.
Thank you, sir.
Thank you.